So these flag patterns are extremely important to be able to identify them on the fly as you're looking at different charts. And I would go through a number of different charts to take a look and see if you can actually establish these types of flag patterns, and you can tell when they're resistance or when they're continuation patterns or when they're going to possibly fail like this. But realize that they will fail occasionally like they did in this flag pattern, but you still had a lower you had higher lows here on this pattern, so there's a high probability that this pattern of higher trends and higher prices would continue. There's lots of material out there that you can read in addition to what I've just told you about continuation patterns. And there are so many different patterns that you can actually, look at charts and try to determine. There's triangles, there are, wide range bar technical analysis type of patterns, and there's about 1 billion patterns. There's like rectangles, and there's all kinds of patterns that people have tried to establish over the years as being more predictive of prices and continuation movements than others. But the flags work really, really well for me. And they make psychological sense too, because when prices are dramatically higher in a single day like this, it makes sense that prices are going to consolidate over a few days in order to, for people who got in early on this uptrend here to begin taking profits. And others who are looking to establish long positions, but additional sellers come into the market. So there's some psychological underpinnings for the reasons why these flag formations do form. But all I know is that they work pretty well over the course of any indice, or if you're trying to establish any type of position in any stock or ETF, they seem to show up in just about every single chart that you look at. In fact, I've gotten so used to using the Dow Jones Industrial Average or the S&P 500 index in conjunction with the VIX, I would never trade without it. I would never establish any kind of position in an index or an ETF without taking a look at both the VIX and the index itself in this way, by looking at flags, by looking at support and resistance points. It's just become second nature to me. And I hope it does for you. And it will become, I think, a habit for you if you begin to look at chart patterns. Take a look at a number of different chart patterns and begin to draw these flags and support and resistance points. And I think it's going to dramatically improve your confidence and your ability to enter into high probability trades in the future. Okay, let's continue here with something a little along a different line. I've showed you the technical analysis that I do on indexes or stocks by identifying flag patterns as well as support and resistance points. Another interesting thing about the stock market is that it will fixate itself at some time upon news events, and that fixation will continue for sometimes a long period of time. And I'm talking about weeks, months, in the year. But it is cyclical, though. So, for example, back during this time of the stock market decline back here, the news was reacting, and the market was reacting to news about the credit crisis, about the mortgage crisis, loans that were going bad in the mortgage industry. A number of financial institutions that were holding these mortgages could not price them, and there was a great deal of news about the credit crunch, the credit crisis that was happening in the United States, and actually it affected some parts of Europe and the UK as well. But every time a news item came out that was negative about the credit crisis or about in this time period, the market reacted negatively and would go down on the news. So, combined with if you can anticipate what the news is going to say about particular events, you can kind of get a head start on, in inputting that news or that correlation to the news into the pricing of the index that you're looking at. It's particularly the Dow Jones Industrial Average or the S&P 500 or something like that. So, if you start to see that there's some correlation between prices in the market and a particular news item, perk up your ears a little bit, because that is going to be the key phrase or the key word for probably several weeks or several months even. Anytime something negative happens in the credit crunch or in these mortgages that were written with no money down mortgages and all these other underwriting tactics that people and brokers had used during the late 19 well, I guess it was going back to late 1990s and early 2006. And now they're coming out that many of these mortgages have gone bad. People aren't repaying the mortgages anymore. As soon as you started hearing about that, you could have, and the market reacted to negative news on that. It was beginning to develop a correlation to that news item. And the market would go down just based on the negative news that would come out about that item. Lately, if we go back over here, lately these downturns in the market, let me just kind of focus in on this a little bit, and we're talking about June of 2008, and you may be watching these videos in the future, so the correlation is going to be completely different. But if you catch the news and you understand that the market reacts to the news, you can begin to develop plug this into the system, the technical analysis system of support and resistance and flags that I've already given you. Now, at this time in history, oil prices have gone up dramatically from about $70 a barrel last August to now it's, at this point it was about $135 a barrel, and that's high or low depending on what time frame you're listening to this. But my point is that when oil started going up, there was a correlation with the stock market to oil. When oil started going up, the stock market would go down on that. At least that was the justification for it, for going down. Whether or not that's actually true or not, I have no idea, but the market does tend to fixate on a particular news item for quite a while. In this case, the market fell pretty dramatically here, about 250 points on this day. This was May 7th. At that time, oil had gone up, and they used the fact that oil had gone up for the market's decline. So there was a beginning of a fixation on oil prices at this time, and a correlation to stock prices. Again, the market kind of rallied up when oil backed off a little bit. Oil went up again, and the market sold off. Oil started to actually recede from those 135 levels down to about 122. And that's the same time that the market had actually started creeping up here in this flag pattern. And then, of course, oil began to increase. And today, the market is down currently 274 points on the news that oil had gone up $7.50 per barrel. So as soon as that,